The Senate just passed the 21st Century Road to Housing Act. The biggest institutional buyers of the last 4 years are now legally forced into exit mode. The inventory wave is starting in 30 days. Here is what renters need to know to do this week. Here is what buyers need to do. And here is the 60-day window that closes on the wrong side if you wait too long. Check this out.
The corporation that beat you on the house did not love it. It did not need the school district. It had a cash offer, an algorithm, and a balance sheet that did not care what the house meant to you. That happened millions of times between 2020 and 2024 across Atlanta, Dallas, Charlotte, Jacksonville, Las Vegas, and Phoenix. Now, two things happened in the same week that tell you the equation just reversed. The Senate passed a bill with nearly 90 votes to force the exit, and the algorithm read the writing before the vote was even taken and started selling anyway. That sounds like the market is finally turning your direction. Here is what nobody is saying clearly. Buried inside this bill is a provision touching $7.7 trillion in American mortgages. And if it is implemented wrong, your rate spikes 100 basis points almost overnight. The headline opens the door. The fine print can slam it on your hand before you get through. Today I want to walk you through what the legislation actually does, the 1968 parallel that shows you both the opportunity and the trap in the same bill. The 30-60-90 inventory cascade already running right now, and what renters and buyers each need to do before summer, because those are two different decisions on two different timelines. The bill is the 21st Century Road to Housing Act. It passed the United States Senate with nearly 90 bipartisan votes. The combined bill merges the original Scott Warren Road to Housing Act, co-authored by Republican Tim Scott and Democrat Elizabeth Warren, with new legislation pushed by Republican Senator Bernie Moreno of Ohio. Trump called for House passage on May 11th, the same week the Senate moved it. The primary House sponsor is Representative French Hill of Arkansas, chairman of the House Financial Services Committee. The National Association of Home Builders endorsed the bill's direction. The National Low Income Housing Coalition published analysis supporting its tax credit reforms. When the Builders Lobby and the Affordable Housing Coalition are both engaging, the bill is real. The 1968 parallel shows you exactly how the opportunity and the trap can live inside the same legislation. In August of '68, Lyndon Johnson signed the Housing and Urban Development Act. It created Ginnie Mae, built the secondary mortgage market from scratch, and made the 30-year fixed-rate mortgage possible for millions of families. Housing starts surged from 1.5 million in '68 to 2.4 million in 1972. And then the trap inside it arrived. Speculators figured out the expanded FHA programs had created a loophole. They bought deteriorating properties for almost nothing and sold them to unqualified buyers. The speculators took the profit. The buyers defaulted. Entire neighborhoods in Detroit, Chicago, and Philadelphia were hollowed out. The same bill that built the modern mortgage market destroyed the communities it was supposed to help most. The ROAD Act runs the same structure. Title I helps first-time buyers with expanded FHA limits, down payment assistance, and tax-advantaged savings accounts. Title III incentivizes zoning reform. And Title IV opens the door to releasing Fannie Mae and Freddie Mac from the direct government conservatorship they have been under since September 2008, 18 years. They guarantee $7.7 trillion in American mortgages, 70% of every home loan in this country. The implicit government guarantee is what has kept mortgage rates lower than they would be in a purely private market. If the GSE release is done with adequate capitalization, the market stabilizes. If it is rushed, the bond market reprices the risk and adds 50 to 100 basis points to mortgage rates almost overnight. On a $400,000 mortgage, that is $130 to $260 added to your monthly payment before you close. Every dollar of down payment assistance can be wiped out by the rate spike. A viewer wrote, "Ever since they started taxing our land and homes, we have been renters. This legislation is the first congressional answer to that grievance in a generation. Whether it delivers or repeats 68 comes down to one title in one bill. The pressure forcing the institutional exit is not coming from the legislation alone. 3 forces hit the largest operators simultaneously, and none of them needed a Senate vote to start running. Federal funding restrictions make new acquisitions unviable. 6 states advancing heavy taxation legislation, Ohio leading with aggressive portfolio taxation, make holding existing portfolios increasingly uneconomic past a specific calendar date. And the institutional sellers are not waiting for any of it to finalize. The algorithmic iBuyers started pricing the exit before the vote. Opendoor launched in-house mortgage products nearly 2 full points below the current market rate.
Hey everyone, real quick, if you want to take advantage of this downturn, you want to buy a house or you want to refinance your house as rates go down, I put together 2 courses, links down below, Mortgage Master Bundle. There's nothing like it on earth. It will blow your mind. You will walk into your next bank appointment or broker appointment to get a loan on a home, and you will blow them away with how much you know and how to save a ton of money at closing and how to save tens of thousands of dollars over the life of your loan. Go check it out. Don't sit on the sidelines. Now let's go save some money, which means making money. All right, let's get back to the video.
When an algorithm pays buyers to take homes off its books, it is not being generous. It is paying to exit. Lawrence Yun described the institutional exit as creating a transitory inventory increase. The RTC liquidation that ran from 1989 to 1995 took Houston and Phoenix 8 years to recover from. That was also called transitory when it started. A market watcher wrote, "The algorithm does not read mainstream real estate coverage. It reads its own earnings report." That is exactly right. And the earnings report changed this quarter. The 30-60-90 calendar tells you how fast it moves from here. Day 0 is now. The Senate bill passed. The executive order is in force. Day 30 is when House action is expected. Day 60 to 90 is when the inventory wave hits the 6 high concentration metros: Atlanta, Dallas, Charlotte, Jacksonville, Las Vegas, and Phoenix are where it lands first. Institutional sellers clearing inventory at discount while cutting new acquisitions creates a net inflow of homes that was not there 90 days ago. Comps begin to reset. Every home in the corridor reprices. The buyer track and the renter track diverge right now and run on different timelines. If you are buying, the first priority is identifying the institutional exit corridors in your target metro before the comps reset. When new listings are running above the 12-month average and days on market are rising in the high concentration zip codes, the exit inventory is entering the window. The institutional seller has a quarterly reporting date. The family seller has an emotional attachment to the price. The institutional seller will negotiate on timeline and condition in ways the family seller will not. Get pre-approved before the window opens. The motivated inventory does not wait for your paperwork. The second part of the buyer track is the GSE spread, the difference between the 10-year Treasury yield and the 30-year mortgage rate. If it widens above 300, the bond market is pricing Title IV risk and your rate is going up regardless of what the Fed does. That spread is the single most important number for your mortgage payment that almost nobody is watching. If it widens while your pre-approval is active, you lock immediately. You do not wait. If you are renting from an institutional landlord, your window is different and it is shorter. The operator has a sell versus hold calculation that changed this month. Ask for a rent concession at renewal. When Opendoor or Invitation Homes signs appear in your corridor, the exit sequence is already running. The window to negotiate from strength closes before the listing goes live. The corporation that outbid you in 2021 is now the most motivated seller in your zip code. The bill designed to help you buy it contains the provision most capable of spiking your rate before you close. The Senate voted, the executive order is signed, the algorithm is already selling. The question is whether you move before the inventory wave resets the comps, or whether the legislation becomes the reason your payment changed. Economic Ninja is out.